Welcome to the Cardinal Commentary for the foreign equity portfolios. It was a great start to the year for the S&P 500. It was the second best performing index from around the world in the first quarter, returning 10.6%, trailing only the Nikkei 225. And there's more good news. After a couple of years of being driven primarily by select few growth stocks, first quarter returns on the S&P were shared across a broader group of companies and sectors. We believe the excitement surrounding artificial intelligence will spread to additional sectors of the economy as investors realize AI will be needed across the supply chain. Semiconductors, where Cardinal has significant exposure, have already benefited, and we expect a broad range of companies that we own in utilities, industrials, and servicing companies will also ride the wave. U.S. inflation rose in the first quarter due to a recent increase in oil and shipping prices. Rising tensions in the Middle East have led to attacks in the Red Sea, while on the other side of the world, drought conditions have contributed to lower shipping capacity in the Panama Canal. While inflation has been trending downward for nearly 2 years, it continues to have flare-ups. Core inflation, which excludes food and energy prices, jumped to 3.7% in the quarter, up from 2% in the last 3 months of 2023. Federal Reserve Chair Jerome Powell believes price rises are nearing an end, just not as quickly as consumers would have liked. The U.S. economy grew by 1.6% in the first quarter, the slowest pace of growth in 2 years, but it follows 6 consecutive quarters of solid growth. Much of that has been on the backs of a strong jobs market. The unemployment rate in the U.S. was 3.8% in March, and it's been below 4% since last summer. But regardless of what's going on around the world, we continue to invest in companies that can weather any storm. Home Depot is one of those companies. Equity analyst David Amy says the home improvement giant is a best-in-class retailer with an exceptional long-term track record, industry-leading revenue growth, and great returns on its investments.
We really like the home improvement market over the long run. Currently, over 50% of homes in the U.S. are over 40 years old, and this supports increased spend on repair and renovation. Additionally, the U.S. has underbuilt its housing supply over the last 10 years, so this supports higher housing prices, which in turn increases home equity and should support investment in the home.
We look for annual dividend growth of 8% to 10% with our companies, so Home Depot, at nearly 20% over the last 12 years, is absolutely an outperformer. 8 of our companies increased their dividends during the first quarter, led by Applied Materials at 25%. Dividend increases are more than just numbers. They also represent confidence by management in their future prospects. Portfolio manager Sheila Wilson-Cole says investors can really benefit by reinvesting that dividend income.
So we often highlight dividend increases, but the other key component of growing wealth in a portfolio is using that dividend income, if you don't need it, to buy more shares in companies. So as a result, when you buy more shares, you're also increasing the dividend income that you ultimately receive. So between buying more shares, getting those dividends from those companies, along with the dividend increases, you really grow wealth over time. And it has quite a snowball effect if you continue to do that over the course of a number of years.
And all of those dividends have contributed to benchmark-beating returns over the last 2 decades. And here's the proof. If you invested $500,000 in this portfolio in 2002, it would be worth nearly $3 million today, outpacing what you would have earned in the benchmark by nearly $400,000. And why do we do all this? Because it works. And that's the Cardinal Commentary for our foreign equity portfolios. Thanks for joining us.